Hi there, welcome back to Market Fatafat. You're watching ET. Now let's take it across to my colleague Ansh, who's standing by with a lowdown of what the markets are up to, why we have been seeing a fall in the Nifty, and some key relevant and important data, everything with everything that's been happening and spooking the markets, so to say, right now. Ansh, take it away.
Well, we are facing market cap erosion of more than 3 lakh crore today. Also, 80% of large and mid-cap stocks are trading in red. Now, if we talk about Nifty, then we have been declining for 4th consecutive session now. And actually, Nifty Financial Service Index is the one which is contributing the most in Nifty's fall today, because today we have Nifty Financial weekly option expiry as well. So that's the reason why we are seeing very strong pressure in Nifty on downside, especially from HDFC Bank. Now, if we talk about other broader indices, then some weakness has been seen in mid-cap and small-cap as well, because both of the indices are also falling for 4th consecutive session. Now, if we talk about Nifty Bank, the Nifty Bank is actually hovering around its 100 EMA from last 29 sessions with a max deviation of just 3% away from it. So here we are seeing some of the consolidation happening. Now, if we talk about sector indices, then most of the sectoral indices are trading in red, but Nifty Realty is the one which is trading in green. Actually, this index had touched its 5-month low level in the previous session, but today we are seeing very good recovery, so a good turnaround in this particular index. So most of the market we are seeing is in consolidation to some weakness, but some selected sectors like Nifty Realty are seeing some good bullish pressure today.
All right, market in bear grip, and this is why the market is, trading in the red, and of course, like Ansh mentioned, a market cap erosion of 23 lakh crores. But let's go across and get a new techie on board now. We have Chandan Taparia, derivatives and technical analyst, Motilal Oswal, who's joining us. Thank you so much for joining us. Good afternoon, Chandan. We'll come to you first then. Infosys is the name that you've picked out for us. Now, Infosys has been in a consolidation mode in the last 1 month. Do you see a reversal coming from here on now?
Nifty index has been making lower top, lower bottom, but the only IT sector is doing well comparatively. Nifty IT has managed to reclaim the decline of the previous week, and Infosys one of the strongest counter, which has seen a recovery from 1700 to all the way to 1880 marks. So higher tops, higher bottom is clearly visible on the daily scale. Even on the weekly chart, it formed a piercing pattern, and follow-up is clearly visible. So I believe some sort of buying interest could continue. With the support of 1830, Infosys has potential to extend the recent momentum towards 1930 to 1950 zone.
All right, moving on then to another counter that is in focus today, and that is Ramco Cement. Now, Ramco Cement hit a 9-month high as the script rallied 7% intraday, amid heavy volumes on expectations of earnings improvement in the second half of FY25. When now, notably, the stock is trading at its highest level since February 2024. But for quarter 2 of FY25, Ramco Cement has posted a 75% year-on-year fall in the net profit at 26 crore rupees, hurt by subdued demand in the monsoon season and falling prices. The revenue also fell 12.5% on a year-on-year basis to 2,038 crore rupees due to drop in cement prices by around 10% on a year-on-year basis, and a drop in volume by 3%. Now, the volume degrowth is due to the weak demand due to the monsoons. The EBITDA per ton declined around 20% on a year-on-year basis, down 4.7% sequentially to 700 rupees per ton, dragged by the lower realizations. Now, Ramco Cement said that the cement capacity utilization has dropped from 82% in quarter 2 FY24 to 75% in quarter 2 of FY25 due to the additional capacities created by way of debottlenecking in quarter 2 of FY25 and commissioning of line 2 in Odisha in the second half of FY24. The company has registered a total sales volume of 8.8 million tons in the first half of FY25, with a marginal degrowth of 1% on a year-on-year basis. On the back of that, Ramco Cement is in focus today.
Okay, so that's the reason why Ramco Cement is buzzing in trade. Let's take a look at another buzzer today, and that's National Fertilizers under some pressure today. And if you take a look at this earnings candidate and the earnings fine print, if you take a look at the numbers on the consolidated sequential basis, revenue has come in at 4,390 crores compared to 5,092 crores, a drop of 13.8% sequentially. When you take a look at PAT, however, that has crossed over to the positive, coming in at 12 crore versus a loss of 9 crores last quarter. EBITDA has come in at 125 crores versus 109 crores, which is up 14.4% sequentially. If you take a look at EBITDA margin, that's also come in at 2.8% compared to 2.1%, which is up 70 bips on a sequential basis. Now, high fertilizer and agricultural chemical inventory and destocking for the past few quarters have pressured the prices, hurting the margins of overall agrochemical makers. This is what analysts is saying. But well, yes, revenue has gone down by roughly 14% sequentially, and on the back of that, the stock is slightly under pressure today, 0.7% lower.
All right, coming to you, Ria, Elgi Equipment is what you picked out for us. An earnings candidate, rather weak set of numbers coming in for the company. Tell us, what does the scorecard look like?
Yes, so Elgi Equipment has posted quite a weak set of numbers in Q2 of FY25. Now, we've seen the revenue going up by around 7.8% on a year-on-year basis, coming in at 869 crores versus 806 crores in Q2 of last year. Even the net profit has gone up around 4% in this quarter, coming up to 95 crores. But on the EBITDA front, we have seen a decline, a marginal decline of 0.8% on a year-on-year basis, coming in at 142 crores in this quarter. If you look at the margins, though, those have declined quite sharply. We've seen a decline of around 141 basis points over the previous year. This time the margins have come in at 16.3% versus 17.7% in Q2 of last year. So overall weak set coming in for Elgi Equipments, and on the back of this, reacting to these negative earnings, the stock is trading with cuts of around 3% right now.
Okay, so that's the reason why the stock is in focus. Let's move on then. And Chandan, you've picked out NTPC on the charts for our viewers. Tell us what levels you are spotting, because when it comes to the last 1 month, this stock has given a negative return of 10%. The price has gone lower. Would this now be an attractive entry point? What's your take going ahead?
Yeah, so talking about NTPC, the stock has been making lower top, lower bottom. It has given a breakdown. In fact, we have seen built up of short position, and it has gone below its key moving averages and the rising trend line. So structure has gone negative. Sustained call writing in derivatives also indicate the downside could be there. So looking at the price structure with hurdle of 392, NTPC can see a more corrective move towards 360 level.
Okay, so those are the levels. 360 on the upside is what Chandan is spotting for NTPC. But let's move on. Talk about a stock that's managing to do pretty well for itself. Gains of more than 3% coming in for L&T Tech. That's the stock we're talking about. Now, the company has announced that it has signed a definitive agreement to acquire Silicon Valley-based IntelliSwift for $110 million. This acquisition, according to the firm, will deepen its offerings across software product development, platform engineering, digital integration, data and artificial intelligence. It will also provide the company access to marquee clients in retail, fintech and high-tech, while strengthening its relationship with hyperscalers as well. Now, with a revenue of $96 million, IntelliSwift serves 4 of the top 5 hyperscalers and caters to over 25 Fortune 500 companies, including 5 of the top 10 engineering, research and development, which is ER&D spenders in the software and technology space. This acquisition will enable L&T Tech to address adjacent markets in retail and fintech, as well as the private equity channels. Positive news flow coming in for L&T Tech. That stock more than 3.5% higher as we speak.
All right, Chandan, you have picked out LTTS on the charts for us. Tell us what you see on the charts for this one. Last 1 month, it hasn't really moved much. Last 1 month, it hasn't moved much. Last 6 months, it has given some 20% returns. Tell us, where do you see this going? It's been pretty flattish in the last 1 month.
Yeah, so LTTS is one of the strongest counter in last almost 4 to 5 weeks, with multiple support even after the weakness in the market. We have seen a surge in the price, and the open interest activity also indicates some uptick in the counter. We have positive on the Nifty IT. Even after the market decline, the entire sector is resilient. So that is the reason that picking to go long on LTTS with support of 5160. We believe this rally can extend towards 5600 zone soon.
5600 is the upside that Chandan spotting on L&T Tech. But on the back of this acquisition, we also spoke with the MD and CEO of L&T Tech, Amit Chadha, who plans to double the IntelliSwift revenue in 3 years, and adds that the company will also be able to add 3 clients in the $20 million plus range. Let's go across and listen in.
Jointly, we'll immediately be able to add up and increase our client pyramid to a lot, 3 more accounts in the 20 million plus range, and giving us the ability to get to $50 million in these accounts. I also feel, given the experience we've got in scaling and growing, we should be able to double IntelliSwift revenue in about 3 years' time. We are still aligned to deliver the 16% EBIT margin levels that we had talked about earlier.
All right, moving on to Suprajit Engineering, that is a stock, another earnings candidate that's in focus today. Tell us, Riya, how does the result look like for this one?
Well, Suprajit Engineering has reported quite a mixed set of earnings in Q2 of FY25. We've seen the revenue going up by around 17.6% in this quarter to 834 crores, but a huge decline on the net profit side of around 98%. Even the EBITDA has gone down by around 9.7% on a year-on-year basis, coming in at just about 63 crores in this quarter. If you look at the margins as well, those have also contracted by around 229 basis points, coming in at just about 7.6% in this quarter. Now, the consolidated results that have been announced have some significant one-offs in this and write-offs as well in this quarter relating to the acquisition of the insolvent SES Germany and its subsidiaries. And on the back of this, the core EBITDA margin now comes in at 12.6%. If you look at the outlook for FY25, the management has said that they remain optimistic about the growth prospects, citing strong order wins and market share gains despite the industry challenges that they are facing right now. And they're also targeting a double-digit growth in the SCD business for FY25 with expectations for improved margins as the pricing stabilizes. But reacting to this, the stock is now down around 2.5%.
Okay, so that's the reason why Suprajit Engineering is in focus. Chandan, you've picked out Coforge for us on the charts. Now, it's a mid-cap IT name. Last 6 months itself, the stock is up 80%. Tell us, what's the outlook going ahead? Can this kind of run-up that the stock is seeing continue, or are you expecting some slowdown? And what are the key levels to watch out for?
So, clearly we are positive on the Nifty IT, and most of the IT stocks are doing well. Coforge is really do well by more than 30% in this calendar year. Has been making art of high bottom. And today, when index is down by 200 points, this stock is still holding well above 8100 zone. So we believe that buying interest could continue with support of 7950. Coforge can head towards 8400 to 8500 bucks.
All right, with that, it's time for us to slip into a short break. Don't go anywhere. After the break, we will get you some more stocks. Welcome back here to Market Fatafat, where we are taking you through all the stocks that are in focus today. And there's an earnings candidate that is in focus today, and that is Bank of India, which is reeling under pressure, selling pressure right now, trading with cuts of 2.2%. But let's take stock of how the numbers have fared. Now, as far as the standalone year-on-year numbers are concerned, Bank of India has reported a 63% jump in the net profit to 2,374 crores for the second quarter, on higher non-interest income. And also the public sector bank has had a net profit of 1,458 crores in the quarter ended in September 2023. The total income increased to 19,872 crores. In the quarter from 16,659 crores in the corresponding quarter of the previous fiscal. Now, the NII, or the net interest income, increased by 4% on a year-on-year basis to 5,986 crores in the second quarter of FY25 against 5,740 crores in the year-ago period. Now, the net non-performing assets, or the NPA, have declined by 29% on a year-on-year basis from 7,900 crores in September 2023 to 5,649 crores in September 2024. On the back of weak set of results coming in for Bank of India, it is reeling under pressure.
Okay, Bank of India under pressure today, but it seems to be that Bank of India is on track to achieve its NIM guidance, according to Rajneesh Karnatak, the Managing Director and CEO at Bank of India. Let's go across and listen into what else he had to say about the company's Q2 earnings.
There has been some impact with the rising cost of deposit. The NIM has been impacted, and also yield on advances are flat. That is one of the basic reasons. And as regards the RBI circular on penal interest, so now we have to book under the penal charges. So penal interest also has gone out of the interest income, and it has gone to the penal charges to the non-interest income. So that has also impacted the overall domestic net interest margins. Yield on advances for us is 8.65 for this quarter. And if you see the repo rate, RBI has not changed after January 2023, and it remains at 6.5%. We are revising this guidance of this slippage because for the simple reason that one single account has slipped during this quarter, and it was a lumpy account. So the slippage ratio, we are now estimating it to be at around 1.4% on a realistic basis.
All right, coming to you, Chandan, Godrej Consumers, GCPL is what you've picked out for us. Now, this stock is reeling under pressure. In fact, not just today, for the last 1 month, it has been in a consolidation mode. Last 6 months, actually, it has been in a consolidation mode. Is it a time for reversal, or how does one play this counter now?
So this stock has been making lower top, lower bottom. Already it has seen a correction of more than 30-40% from its top, all the way from 1540 to 1175 marks. On weekly scale, it has been making lower top, lower bottom from last 9 to 10 weeks, and still the weakness persists. It has broken its rising support trend line. The immediate and short-term trend has turned negative. So till it holds below 1210, further weakness or profit booking could continue, which can take it towards 1120 to 1100 zone.
1100, that's the levels Chandan is spotting for Godrej Consumer. But let's talk about another stock in focus today, and that's NMDC. Now, largely mixed set of numbers coming in from this company. The revenue was ahead of the consensus estimate, but the EBITDA was below what the street was expecting. If you take a look at these numbers on a consolidated sequential basis, revenue has come in at 4,919 crores, which is down roughly 9% on a sequential basis. Net profit also has seen quite the cut, coming in at 1,196 crores compared to 1,963 crores, which is down 39% sequentially as well. If you take a look at the EBITDA though, that's coming at 1,386 crores compared to 2,340 crores, which is down almost 41% sequentially. EBITDA margins also very steep cut coming in on this front, 28.2% compared to 43.2%, more than a 1,500 bips cut coming in just on a quarter-on-quarter basis. Now, raw material costs were higher than estimates, which impacted EBITDA. Higher raw material costs, higher selling and other expenses have also weighed heavily on the earnings this time, and EBITDA margins are 28.2% at the lowest since Q2 of FY23 due to low iron ore prices. Although the company has a healthy cash position of 14,270 crores, but well, yes, the operational performance, the earnings for Q2 look largely weak, and on the back of that note, the stock is down 2.3%.
All right, that's NMDC, but L&T is also in focus today. Ria, tell us what's the news flow here?
L&T is in focus today on the back of a big order win coming in for L&T Energy Carbon Light Solutions, which has secured a limited notice to proceed notice from NTPC for setting up thermal power plants, 3 big thermal power plants in India. Now, the exact order value has not been disclosed, but it falls under the ultra mega order category, which indicates that the order value is upwards of rupees 15,000 crores. Now, the scope of the work on this front involves design, engineering, manufacturing, supply and commissioning work for boilers, turbines and ESPs, along with the related mechanical and civil works. So on the back of this big order coming in for L&T, the stock is in focus, but right now the stock is seeing some selling pressure, trading with cuts of almost 1%.
Okay, so that's the reason why L&T is in focus, but still under some pressure as we speak. Now, Gautam Duggar, the head of research at Institutional Equities Motilal Oswal, says that the capital goods and industrials have performed better than expected in Q2 on the back of heavyweights like L&T. Let's go across and listen into what his view is on the stock as well as the entire sector.
The capital goods and industrials universe that we cover, the numbers have been better than expectations. That's because of few of the heavyweights like L&T, where the expectations were very low, and they've managed to beat those expectations. You've seen good numbers from Cummins. The only miss was, I think, ABB. So overall, in an otherwise very soft scenario, and top down also capex being down, at least this quarter the impact is not so clearly visible. That's why I mentioned, if October onwards the government machinery starts spending, capex spending starts reviving. Because look at the numbers. Government has budgeted for 11.1 lakh crore of capex spending this year. First half, which is April to September, the total capex spending was down 15 to 17%. Whereas the full year expectation is that as per the budgeted number, it should grow 17%, which essentially implies that for the second half of FY25, the capex spending has to go up 52% YOY, which is very difficult in my view. Even if it goes up 30-40%, it will provide very strong legs to the execution and order book. So any correction, we are very positive on industrials. We have a big overweight there. We have L&T, we have ABB in our model portfolios. So any correction there because of this quarter or 2 quarter of weak earnings, we would suggest to buy into it, provided you have at least a 3-year of a horizon.
Right, moving on, then coming to you, Chandan. Marico is the name that you've picked out from the FMCG pack for us. this entire pack, this entire FMCG pack has not been doing that great. You know, in the last 1 month, it has been in a consolidation mode, and so is Marico also. In fact, tell us from here on, do you see a reversal coming in on Marico, or how does one look at this?
Yeah, so talking about Marico, as I mentioned that most of the FMCG name are making lower top, lower bottom, and Marico has seen a corrective move in last 2 months. The structure is weak. Looking at the current price structure, with hurdle of 615, it can still see the more profit booking, which can take it to 570 to 565.
565 in fact are the levels that Chandan spotting on Marico, lower than where the current stock price is. But Ria, you've picked out RVNL and no points for guessing. I'm sure it must be on the back of another order win.
Yes, absolutely. So RVNL is in focus on the back of another order win. Now the company has emerged as the L1 bidder for an EPC contract for the doubling of a track line, including the electrification and signalling works of South Central Railway in the state of Telangana. Now the estimated execution timeline for this project is 24 months, and the broad consideration of the order is rupees 295 crores. So quite a significant order coming in for RVNL yet again. Now the stock was up around 1% reacting to this in the morning, but right now it has pared some of those gains, but still trading marginally in the green.
Okay, so that's the reason why RVNL is in focus today. But let's move on and talk about the next stock, that's Triveni Turbine. Let's pull up the charts and take a look at what the stock is up to right now. Because if you take a look at the Q2 numbers, they seem to be largely positive on a consolidated basis. Revenue is at 501 crores compared to 388 crores, which is up 29.2%. The net profit is also jumped up at, by roughly 42%, coming in at 91 crores compared to 64 crores. EBITDA has come in at 111 crores compared to 74 crores, which is up roughly 50%. And EBITDA margins have also expanded quite sharply at 22.2% compared to 19.2%, which is up 305 bips on a year-on-year basis. Now, the company in its annual report has emphasized its strategy to expand its footprint in key international geographies and widen its product offerings, scale up the aftermarket business, and continue its focus on innovation. Now, on the back of that, you have Motilal Oswal that's maintained a buy rating with a hiked and revised target price on the stock coming in at 830 rupees. So quite the bullish outlook coming in from Motilal Oswal. Good set of numbers coming in, and the stock is up more than 5% in today's trade as we speak.
Alright, with that we're completely out of time on this edition of Market Fatafat. Chandan, Rhea, thank you so much for joining us. With that, it's curtains done on this edition of Market Fatafat. Snehi and I will take your leave. Thank you so much for tuning in. Don't go anywhere because closing trades is up next.
If you like this video, then like, share and subscribe to ET Now.